Edgar Orn Smith set out to write a book on bonds versus stocks. And he said if he went in with the idea that bonds would be a better investment in times of deflation and stocks would be a better investment in times of inflation. And the first line of his book was to say that he'd been wrong. But he had enough sense to look at his evidence. I think Darwin said if you found evidence that was contrary to what you already believed, write it down in 30 minutes or your mind will just block it out. I mean, people have a great resistance to new evidence. And he said, if a stock yields 4% and a bond yields 4%, which was what he was talking about then, the stock was going to outperform the bonds because there were retained earnings that were building beyond that yield. And that has been true for a long, long time, but nobody paid any attention to it. We don't get rich on our dividends that we receive, although we're happy to receive them. We get rich on the fact that the retained earnings are used to build new earning power, repurchase shares, which increases your ownership in the company. And Berkshire has retained earnings ever since we started. That's the only reason Berkshire's worth a lot more is we retain earnings.